Over 90% of day traders lose money. Not eventually, not sometimes. Statistically, consistently, year after year, across every market, every broker, every country that tracks the data. And here's what nobody wants to tell you. It's not because they picked the wrong strategy. You could hand the 90% a strategy with a proven edge. Something back-tested, something that's made other people millions. And most of them would still lose. Give them the exact playbook of a professional trader. Same entries, same exits, same risk rules written down in black and white. They'd still blow the account. Today, I'm going to show you exactly why that happens. Not the surface level reason you've heard 100 times. The real one. The one sitting underneath every failed strategy, every blown account, every trader who swears the next system will finally be the one that works. You're smart. Let's start there, because it matters. You've read the books, you've watched the YouTube videos, probably including 10 just like this one. You've back-tested, you've journaled, you've paid for the course, maybe more than one. You are not lazy, and you are not stupid. And you're still losing. So it's not intelligence, it's not access. You have the same charts as everyone else, updated in real time, free. It's not capital, because plenty of well-funded traders blow through accounts just as fast as the guy trading $300 from his phone. It's not even strategy, because strategies get swapped every few months by the same people, chasing the next one, and the results don't change. The difference is this. The 5% who make it have made peace with something the 95% are still fighting. And that fight is invisible. It doesn't show up on your chart. It shows up in your nervous system, in the half second before you click the mouse, in the story you tell yourself about why this trade is different. Let me show you what that looks like in two people. David is an engineer. Mechanical background, sharp mind, the kind of person who solves problems for a living and expects the market to eventually behave like a problem too. When David started trading, he did what smart people do. He studied. He learned moving averages, then RSI, then MACD, then Fibonacci retracements, then volume profile, then order flow. By the end of his first year, David's charts had 47 indicators running across 4 monitors. Colors everywhere. Arrows, zones, boxes, lines, stacked on lines. David believed that if he just added one more layer of analysis, the noise would finally resolve into a signal. That's the trap smart people fall into, because it's worked for them their whole life. More study, more data, more preparation, in school, in their careers, has always produced better outcomes. So why wouldn't it work here? Because the market isn't a problem to be solved. It's a game of probabilities being played by millions of people at once, and no amount of additional analysis changes that. David's 47 indicators didn't produce clarity. They produced 47 ways to talk himself into a trade he shouldn't have taken, and 47 ways to freeze on one he should have. Within 18 months, David had gone through 4 trading accounts, total losses north of $60,000. He blamed the algorithms, he blamed market makers, he blamed a Federal Reserve announcement that wasn't supposed to happen that way. He never once blamed the fact that his chart looked like a Christmas tree decorated by someone having a breakdown. Now meet Maria. Maria was a nurse for 11 years before she started trading. No finance background, no engineering brain looking for a system to crack. She started with one simple rule: risk 0.5% of her account per trade, and only take trades that lined up with the overall trend on a higher time frame. That's it. 2 rules. People laughed at how basic it was. Maria didn't care. She'd spent over a decade in an ICU, where the difference between a good outcome and a bad one usually came down to following the protocol under pressure, not improvising, not getting clever, not letting adrenaline make the decision for you. She brought that same discipline to trading. Her charts had one moving average and a horizontal line marking support and resistance. That's all. She didn't need to understand exactly why her edge worked. She only needed to know that it worked slightly more often than it didn't, and that if she executed it the same way every single time, the math would eventually take care of the rest. 3 years later, Maria is consistently profitable. Not dramatically. She's not buying a Lamborghini. She's making steady, unglamorous returns, month after month, quarter after quarter. Boring, reliable, replicable. Same market, same charts, more or less, same 24 hours in the day. So what was actually different? Not intelligence. David was smarter on paper. Not effort. David worked harder by any measure. The difference was that Maria made trading stupidly simple, and she trusted that simplicity while David kept adding complexity because complexity felt like control. That single distinction is the doorway into everything else I'm about to explain. So let's open the door and look at the 6 forces that actually decide whether you end up in David's group or Maria's. The first force is complexity addiction. Here's how it works in your brain. Every time you add a new indicator, run a new backtest, or read one more article about market structure, your brain releases a small hit of dopamine. It feels like progress. It feels like you're doing something. But activity is not the same as edge. And for most traders, that dopamine hit becomes the actual addiction. Not trading itself, but the endless preparation for trading. The 95% chase complexity because it feels safe. If the system is complicated enough, surely it can't fail. That's the unconscious logic. The 5% do the opposite. They strip everything down to the minimum number of variables that produce a repeatable edge, and then they stop adding. The second force is the intelligence trap. And this one stings the most for smart people watching this video. You've been taught your whole life that intelligence is your edge. Better grades, better jobs, better outcomes, because you thought harder and worked smarter than everyone else. Trading doesn't respect that pattern. PhDs blow accounts, doctors blow accounts. Engineers with 6-figure salaries blow accounts at the same rate as everyone else, sometimes faster, because their intelligence makes them exceptionally good at constructing convincing reasons for a bad trade. Your IQ is not your edge in this game. In fact, past a certain point, intelligence becomes a liability, because it gives you the tools to rationalize impulsive decisions as calculated ones. The third force is the control illusion, and it's the deepest one. Every trader wants to control the outcome of a trade. You can't. Nobody can. What you can control is your process, your entry criteria, your position size, your exit rules, how you react after a loss. That's it. That's the entire list. The 95% spend their energy trying to predict the unpredictable, trying to grab smoke, gripping tighter every time it slips through their fingers. The 5% stop trying to control outcomes a long time ago. They control exactly one thing religiously and let probability handle the rest. The fourth force is emotional leverage. Not the leverage on your account, the leverage inside your head. This is the gap between how much money is actually at risk and how much it feels like is at risk. A $100 loss can feel like a personal catastrophe if your identity is fused with your P and L. That emotional leverage causes traders to revenge trade, to move stop losses, to size up after a losing streak trying to win it back. The 5% have deliberately shrunk that gap. They size their trades so small relative to their account and their tolerance for stress that a loss is just data. Annoying? Sure, but not a threat to their sense of self. The fifth force is what I'd call outcome bias, judging a decision by whether it worked instead of judging it by whether it was correct, given the information available at the time. A trader takes a low probability, undisciplined trade. It happens to win. Their brain files that away as validation. See? That worked. Another trader takes a perfectly disciplined, high-probability trade. It happens to lose, because even great setups lose sometimes. Their brain files that away as failure. This strategy doesn't work. That's backwards, and it's one of the most destructive feedback loops in trading, because it trains you to repeat exactly the wrong behaviors and abandon exactly the right ones, based on random short-term outcomes instead of long-term process. The sixth and final force is what happens after the loss. Not the loss itself, but the 90 seconds that follow it. This is where most accounts actually die. Not in the losing trade, in the next one, taken out of frustration, taken to fix what just happened, taken with size that violates every rule the trader claims to follow. The 95% let one bad trade dictate the next 5. The 5% have built a hard stop between emotion and execution. A rule, a pause, a walk away from the desk. That breaks the chain before it starts. There's a 7th force worth naming because it quietly fuels all 6 of the others. Information overload, disguised as diligence. Every piece of market commentary, every prediction from a talking head, every headline about inflation or interest rates or a surprise earnings report, all of it gets consumed by struggling traders as if it's essential input. It isn't. Most of it is noise wearing a suit. It's someone's opinion packaged to look authoritative, competing for your attention against thousands of other opinions that will be proven wrong by lunchtime. The 95% believe that more information leads to better decisions. In trading, past a very low threshold, the opposite is true. More information means more conflicting narratives, fighting for space in your head at the exact moment you need to execute a simple rule. The 5% have ruthlessly cut their information diet down to only what their process actually requires: price and whatever handful of inputs their edge is built on. Everything else gets ignored, not out of laziness, but out of discipline. 7 forces now: complexity addiction, the intelligence trap, the control illusion, emotional leverage, outcome bias, the post-loss spiral, and information overload. None of them show up in a back test. All of them show up in your account balance. So how do you actually shift out of the 95%? Not with more motivation, with specific, concrete changes to how you operate. Let's go through them one at a time, matched directly to the forces we just covered. Shift 1 addresses complexity addiction, and it's brutally simple. Delete indicators until it hurts. Not add, delete. Pick one, maybe 2 tools maximum, and force yourself to make decisions with radically less information than you're used to. Maria's entire system ran on a moving average and a horizontal line. When traders finally strip their charts down this far, most report the same thing. Decisions get faster, clearer, and, counterintuitively, more profitable. Complexity was never adding an edge. It was adding hesitation dressed up as analysis. Shift 2 addresses the intelligence trap. Stop trying to be right and start trying to be consistent. Reframe every single trade not as a prediction you're making, but as a bet with a known favorable probability that you're executing for the 1,000th time. Casinos don't predict which number comes up on the roulette wheel. They don't need to. They have a mathematical edge, and they execute it the same way every time, regardless of the last 10 outcomes. That's the model. Your intelligence should go toward designing and refining the edge, not toward outsmarting individual trades in real time. Shift 3 addresses the control illusion, and the concrete action here is what I'd call process scoring. After every trade, don't just log whether you won or lost. Score yourself separately on whether you followed your process, entry criteria, position size, exit rule. A trade can lose and score a perfect 10 on process. A trade can win and score a 2. Over weeks and months, start paying more attention to your process score than your P&L. The P&L will follow the process eventually. It always does, if the edge is real. Shift 4 addresses emotional leverage, and the fix is almost embarrassingly mechanical. Cut your position size until the outcome of any single trade produces no measurable emotional reaction. If you feel your pulse change when a trade goes against you, your size is too big. Full stop, no exceptions. Most traders think they need to build emotional toughness to handle bigger size. It's actually the reverse. You reduce size until your nervous system stops treating the market like a threat, and only then do you have any chance of executing your rules under pressure. Shift 5 addresses outcome bias with a single habit. Before you enter a trade, literally write down, why you're taking it, based only on your criteria, not on how confident you feel. After the trade closes, compare the outcome to that written reasoning, not to whether you made money. This single habit, done consistently, retrains your brain to evaluate decisions instead of outcomes, which is the actual skill that separates professional judgment from gambling. Shift 6 addresses the post-loss spiral, and it requires a rule enforced before you ever need it. After any loss, or any string of two losses, you are done trading for a fixed period. An hour. The rest of the session. Whatever works for your style, no exceptions. No, just one more to fix it. The 5% don't trust themselves to make good decisions in an emotionally activated state, so they don't give themselves the option. They remove the decision entirely in advance while they're calm. Shift 7 addresses information overload, and it's the simplest one on this list to explain and the hardest one to actually live by. Go on an information diet. Pick the handful of inputs your process actually depends on, and cut everything else. The financial news channel running in the background, the group chat full of other traders' hot takes, the accounts you follow that post 15 times a day about what the market is about to do. None of it improves your execution. Most of it just adds anxiety to a decision that should be mechanical. Traders who make this cut often say the same thing within a few weeks. The market didn't get quieter, but their head did. 7 forces, 7 shifts. But here's the thing. You can implement every single one of these tactically and still fail if you don't make the deeper shift underneath all of them. Because tactics change what you do. Identity changes who you are. And until the identity shifts, the tactics eventually get abandoned the moment things get hard. Most struggling traders have quietly fused their identity with the outcome of their trades. A win means, I'm good at this. A loss means, I'm bad at this. Or worse, I'm bad. Period. That fusion is the real reason David couldn't stick to a system. Every loss wasn't just a financial event. It was a threat to who he believed himself to be. So he kept changing strategies, not because the strategies were failing, but because he needed a new story that didn't implicate him personally. The 5% have separated those two things. They are not their trades. A loss is information about probability, not a verdict on their worth or competence. When you stop being someone who trades to prove something and become someone who trades to execute a process, the emotional charge drains out of every individual outcome, and something strange happens. You start executing the rules you already knew, the ones you've read about a dozen times, because they're no longer competing against your ego. This is the shift nobody sells you, because it doesn't fit in a course. There's no indicator for it. No signal service delivers it to your phone. It happens quietly, usually after enough pain, when a trader finally stops asking, how do I win this trade? And starts asking, how do I become someone who executes a good process regardless of any single outcome? And here's where I need to deflate some excitement, because most people watching this are still, somewhere, hoping trading is going to feel thrilling once they finally figure it out. It's not going to feel thrilling. If it does, you're probably doing it wrong. The 5% describe their trading as boring, genuinely boring. Same setups, same size, same rules, day after day, week after week. No adrenaline spikes, no white-knuckle moments, no stories to tell at a party. It looks from the outside almost nothing like the trading you see clipped and edited on social media. The screenshots of six-figure days, the countdown to Lambo energy, the traders performing excitement for an audience. That's not what professional execution looks like. Professional execution looks like brushing your teeth. You don't feel triumphant when you brush your teeth correctly. You just do it the same way because you know what happens if you don't. Boredom in trading is not a warning sign. It's a metric. It means your position size is appropriate, your process is internalized, and your emotions aren't hijacking your decisions. If your trading feels like a war, high stakes, high drama, constant vigilance against an enemy trying to take your money, you're playing the wrong game. The 5% aren't fighting a war. They're playing a game, they've already mathematically won over a large enough sample size, and they just need to keep showing up and executing. So let's go back to David and Maria, because their story isn't finished. David eventually stopped trading altogether, at least for a while. Not because he ran out of money, though he nearly did. He stopped because he finally admitted out loud to a friend, that every new strategy he adopted was really just a new attempt to avoid feeling the same thing. The fear of being wrong, dressed up as market analysis. When he came back to trading a year later, his charts looked almost nothing like before. One indicator, a hard rule on position size, a written process he checked before every entry. He's not rich, he's consistent. And for the first time, he says trading feels calm instead of exhausting. Maria is still doing exactly what she was doing 3 years ago. Same 2 rules, same modest position sizing, same unglamorous, steady growth. She still works part-time as a nurse, not because she has to, but because she likes the structure it gives her week. The same instinct, it turns out, that made her a good trader in the first place. Same markets, same 24 hours, same information available to anyone with an internet connection. The only real difference between the outcome David got and the outcome Maria got was what happened inside their heads in the half second before they clicked the button. And whether they'd built a process strong enough to survive that half second intact, that's the actual reason 90% of day traders fail. Not strategy. Strategy is the easy part. You could learn a profitable system in a weekend. The hard part is becoming the kind of person who can execute that system with a boring, disciplined, unglamorous consistency, trade after trade, loss after loss, without letting your ego rewrite the rules in real time. You have 2 options from here, and they're the same 2 options every trader watching this has always had. You can keep doing what the 95% do, chasing the next indicator, the next strategy, the next thing that promises to finally make trading feel controllable. Or you can make the shift, strip it down, shrink your size until losses stop feeling like threats. Score your process instead of your P&L. Build the hard stop before the loss happens, not after. Nobody is going to make that shift for you, and no strategy is going to make it unnecessary. So the only question left is the one you actually have to answer yourself. Are you trading to be right, or are you trading to be consistent? Because only one of those turns you into the 5%.